Welcome back to the PwC Insights channel. I'm joined here today by Nils Cousin, Director in the Washington National Tax Practice. Welcome, Nils.
Thank you for having me, Nick.
So, Nils, recently Treasury and the IRS released the final anti-hybrid regulations. They generally retain the overall structure and basic approach of the 2018 proposed regs. As always, the preamble addresses taxpayer comments, adopts some, does not adopt others. Let's take a look first at Section 245 CAFEE. What are some key takeaways for hybrid dividends?
Well, I think there's two main areas where there are really comments that were addressed and changes were made or were not made or clarifications were made. And the first is the definition of foreign deduction or other tax benefit. There's a clarification that this is not limited to current year deductions, that foreign disallowances based on anti-hybrid rules or limits based on percentages of income, such as thin capitalization rules, are not relevant. There are notional interest deductions are addressed. Treating them as hybrid deductions is retained. And there's a provision that clarifies whether only deductions with respect to foreign federal taxes or also subnational taxes need to be considered. And that provides that in certain circumstances, you do have to take into account subnational law. And the second area really is sort of the maintenance of hybrid deduction accounts. There's a helpful rule that says technical CFCs that don't have any actual direct or indirect U.S. shareholders don't need to maintain a hybrid deduction account. There's some clarity as to what happens with hybrid deduction accounts and how to allocate them with divisive corporate transactions, such as under Section 355. There's also clarity that where a person acquires a CFC and does in a stock acquisition, but makes a 338G election, that there would be no succession to the hybrid deduction account. And finally, there's a clarity that there's no subpart F inclusion for tiered hybrid dividends for an individual.
So those highlights are from the final 245 CAFEE regulations. I understand we also received some proposed regulations under that section. What are some things we should be aware of there?
The reason that we have proposed regulations in addition to final regulations is in large part is because with the 2018 proposed regulations, they did not really address what to do with the hybrid deduction accounts when there would be subpart F inclusions or guilty inclusions for a U.S. shareholder. And the proposed regulations in 2018 suggested a couple of different approaches as possibilities and requested comments. And here, these proposed regulations now take an approach of reducing hybrid deduction accounts for those types of inclusions.
That makes sense. So the other major provision covered in the final regulations is Section 267 CAFE. Here it looks like the Treasury took note of some taxpayer comments and made several changes. What are some of the key changes?
All right, so again, we can say that some narrow the application of the proposed regulations, some expanded, some clarified, and of course, some comments were not adopted. So I can break it down again into a few major groupings. First, let's talk maybe about the general definitions of hybrid and branch arrangements. There are some clarity about the long-term deferral and how to apply those. There is an exemption from those rules for certain sale license transactions where the U.S. would see a license of IP, but the foreign country would see a sale. There's clarity on this dual inclusion income standard for disregarded transactions, and a helpful rule that certain exempt dividends would still be treated as dual inclusion income. The rules for reverse hybrids have a couple fairly significant changes. One is a helpful change. It provides that a reverse hybrid rule will not apply if an entity that otherwise would be a reverse hybrid distributes all of its income to its interest holders during the tax year. On the other hand, there is an expansion of the definition of the types of entities that could be reverse hybrids that's designed to deal with certain concerns that Treasury and the IRS, at least according to the preamble, had about certain types of collective investment vehicles. The second category really is the rules as to whether an item is included in income. There is again, what I think is probably a clarification in the final regs that a recovery of basis or payment of principal can include a no inclusion outcome. There's an expansion of the rules that are related to deduction no inclusion outcomes for Section 951 and 951 Cap A inclusions. And there's a new exception, which is helpful from the no inclusion definition for PFICs that there are QEF elections and the income is taken into account by a U.S. tax resident. And then finally, we've got some changes to the definition of a structured arrangement, and that could cause these rules to apply to certain scenarios that would likely not have been caught by the proposed regulations.
It also looks like there was a significant change to the definition of interest under the final 267 Cap A regs. Can you tell us more about that modification?
So this is a really interesting, the proposed 267 Cap A regulations had a pretty broad definition of interest. It looked really similar to what was in the Section 163J proposed regulations. And interest included not just stated interest, original issue discount, the types of things that are generally treated as interest for U.S. tax purposes, but it also included a lot of other things that we traditionally think of as interest that are either related to the cost of borrowing or are incurred in relation to the issuance of debt. So you would have things like guarantee fees, guaranteed payments, commitment fees that are paid to lenders, even the debt issuance costs that might be paid to other people, such as legal fees or things like that, were treated as interest both in those 163J and proposed 267 Cap A regulations. They have, in these 267 Cap A regulations, have scaled that back pretty significantly, set up a definition of interest that much more closely aligns to the classical tax definition of interest, but subject to an anti-abuse rule that would treat all these other types of costs or payments as interest if they were entered into with a principal purpose of reducing the costing in such a way to circumvent the 267 Cap A regulations. So, of course, we still haven't seen final guidance under Section 163J, and we don't know what that is going to say. But one interesting thing about these regulations is that the preamble in discussing these changes said that the reg drafters under 267A were at least partially influenced by comments that were received on the proposed 163J regulations.
That's an interesting narrowing of the definition. Nils, how about a bonus round? We also received proposed regulations regarding certain anti-conduit rules under Section 881. Can you give us a little more detail on those provisions?
Sure, Nick. So, this one is a little bit of a surprise, I suppose, because it's not actually a classic anti-hybrid provision. The U.S. anti-conduit regulations under Section 881, and those allow the IRS to essentially, for the withholding tax purposes, recharacterize transactions that are linked via financing transactions and where there's an intermediate entity that is inserted into an arrangement, essentially with the purpose of avoiding U.S. withholding tax that would be imposed without the intermediate entity. And those rules generally require the financing entity, immediate entity, and a finance entity to be linked via financing transactions. And equity generally under these rules is not treated as a financing transaction except for certain types of redeemable equity. And what these proposed regulations propose to do is to treat any type of equity that otherwise that's not redeemable, but for which the tax resident, the foreign corporation, is allowed a deduction for its tax law, including a notional interest deduction, for treating that as a financing transaction. And so the result of that is not that you automatically have an issue under the conduit regulation. The result of that, you now will have to do more analysis to determine whether the entity that holds the stock with respect to which there is a notional interest deduction, if that's a financing entity now, does that present a problem under the anti-conduit regulations?
an interesting addition to this package. With that, I want to thank you, Nils, for joining us today and providing such a great summary of some of the key provisions. I want to remind our audience that these regulations have many more provisions, very complex. We were not able to dive into everything today, so I encourage you to read our PwC Insight for additional information and analysis.
Thanks for having me.